Have you seen the numbers lately? In just 2 years, companies have poured over $10 trillion into artificial intelligence. We've watched Nvidia's stock price rocket from $150 a share to over $900. Microsoft has dropped more than $60 billion. Everyone from the biggest tech giants to the smallest startups is betting everything they have on AI. But what if I told you the math doesn't make any sense? Companies are spending hundreds of billions of dollars, and they're making almost nothing back. This isn't just hype. This is .com 2.0, but on a scale we've never seen before. Today we are going to pull back the curtain and look at the brutal reality of the AI bubble. Let's start with the spending. It's truly mind-boggling. Just on infrastructure, the servers, the chips, the data centers, we're looking at about $1 trillion spent over just 3 years. In 2023, it was $200 billion. This year, it's projected to be $350 billion. Next year, over $400 billion. And that's just the foundation. The big 5 tech companies alone have burned through $300 billion in 2 years. Microsoft leads the pack with over $60 billion, which includes their famous $13 billion investment in OpenAI. Google isn't far behind at $50 billion. Meta has spent $40 billion, and Amazon is in for $30 billion. The poster child for this spending spree is Nvidia. Their revenue exploded from $15 billion in 2022 to an estimated $100 billion this year. Why? Because they make the chips everyone needs. Their H100 and H200 chips sell for between $25,000 and $40,000 apiece. To build a single, powerful AI cluster, a company might spend anywhere from $500 million to $1 billion. The money is flowing like a river, but it's all going in one direction, out the door. So with all this money being spent, where's the revenue? This is where the whole story starts to fall apart. Let's look at OpenAI, the company that started this frenzy. They're expected to bring in about $3.5 billion in revenue, but their costs are over $5 billion. That means they're losing nearly $2 billion a year, yet they're valued at $150 billion. That's 43 times their revenue for a company that's hemorrhaging cash. What about the big players? Microsoft's AI division is pulling in about 10 to 15 billion in revenue. That sounds good, until you remember they've spent $60 billion. At this rate, it would take them 4 to 6 years just to break even on their investment, assuming their costs don't keep climbing. Google's AI revenue is a bit better, around 15 to 20 billion, but they've spent $50 billion. To make matters worse, they're giving away their flagship model, Gemini, for free just to compete. They're literally giving away a product that cost them billions to create. Meta has spent $40 billion on AI, but their new AI products generate almost no revenue. They're mostly free features. And Amazon? They're making 10 to 15 billion from AI services, but they've spent $30 billion. We all know Alexa has been losing them billions of dollars every single year. The math is simple and terrifying. The big tech companies have spent a combined $300 billion to generate maybe 10 to 15 billion in new revenue. That's a 20-to-1 spending to revenue ratio. They would need 20 years just to get their money back, and that's not how business works. So why isn't the revenue showing up? The use cases just aren't as big as everyone hoped. Take ChatGPT. It has about 10 million subscribers paying $20 a month. That's $2.4 billion a year. It's a lot of money, but it's not enough to cover the billions in computing costs. Microsoft's Copilot has fewer than 5 million users, bringing in less than $2 billion annually. It's just not enough to justify the expense. Worse, growth has plateaued. The number of new sign-ups for these services is roughly equal to the number of people canceling their subscriptions. The market is much smaller than anyone wanted to believe. What about the enterprise market? Companies are using AI to boost productivity, and an MIT study found it can improve efficiency by about 26%. That's good, but it's not transformational. It's an improvement, not a revolution. It certainly doesn't justify the hundreds of billions of dollars being thrown at it. This leads us to the cost crisis. The core problem is that AI is incredibly expensive to run. Training GPT-4 cost over $100 million in compute power alone. But training is a one-time cost. The real killer is inference, the cost of actually running the model to answer a query. Each query costs between 1 and 4 cents. If you have a service handling 10 billion queries a month, That's up to $5 billion a year just to keep the lights on. And here's the scariest part. The models are getting bigger and more expensive, not cheaper. GPT-5 will cost more to train and run than GPT-4. This model can't scale profitably. The more popular it gets, the more money it loses. And it's not just a financial crisis, it's an energy crisis. Training GPT-4 used enough electricity to power 5,000 homes for an entire year. A data center with just 10,000 AI chips runs continuously at 7 megawatts. A large facility can consume up to 70 megawatts, which translates to an annual electricity bill of $75 to $150 million. By 2027, the AI industry could consume more electricity than the entire country of Argentina. This is fundamentally unsustainable. So what does this all mean? It means we're in a massive bubble. Look at Nvidia. Its stock is up 6 times in 2 years, with a market cap of $3 trillion. Its price-to-earnings ratio is 65. Anything over 50 is typically considered a bubble. Nvidia is priced for absolute perfection. Any hint of a slowdown, any sign that the spending is tapering off, and that stock could come crashing down. This feels exactly like the dot-com bubble of 1999 and 2000. Back then, internet stocks exploded, fueled by hype and dreams of a new economy. Then the bubble burst, and the Nasdaq crashed by 78%. $3 trillion of value vanished. The companies that survived, like Amazon and Google, were the ones that had real revenue and a path to profitability. The companies that died were the ones that only had hype and a high burn rate. Sound familiar? AI in 2024 is the internet in 1999. The technology is real, but the valuations are based on impossible expectations, and most of these companies have no viable business model. The costs are just too high. So what will trigger the crash? It could be a major AI startup failing spectacularly, burning through billions before shutting down. It could be revenue growth completely stalling out, as we're already seeing with services like ChatGPT. Or it could be companies finally admitting that the costs are unsustainable and cutting their AI spending, which would create a doom loop for the entire industry. Here's my prediction for how this plays out. I believe we'll see a 50 to 70% decline in Nvidia's stock, taking it from $900 back down to around $300. That alone would wipe out $2 trillion of market value. Big tech companies like Microsoft and Google will see a 20 to 40% decline, as they are forced to write off their massive AI investments. And for the pure-play AI startups, I expect 90% of them will fail. The only ones left standing will be those that are actually generating real, sustainable revenue. I think the timeline will look something like this. In 2025, we'll see the spending start to slow down, and the stocks will begin to decline. By 2026, companies will start missing their revenue targets, and Nvidia could be down 40 to 50%. By 2027, the bubble will have officially popped, leading to mass failures and consolidation. And by 2028 or 2029, the market will stabilize. The survivors will remain, and AI will become what it was always meant to be. Essential but boring infrastructure, just like the internet or the cloud. The valuations will finally reflect utility, not hype. In total, I predict we could see $8 trillion of the $10 trillion invested simply vanish. So why does this matter to you? If you own Nvidia stock above $700 a share, you are taking on significant risk. Big tech stocks are safer, but a 20 to 40% decline is very realistic. And if you're invested in AI startups, you're facing a 90% chance of failure. This isn't financial advice, but it is pattern recognition. The technology is real, but the expectations are impossible. And when expectations meet reality, reality always wins. Consider de-risking your portfolio, take some profits off the table and diversify. The big opportunities will come after the crash, when you can invest in the real winners at a reasonable price. Thanks for watching. If you found this analysis helpful, be sure to like, subscribe, and hit that notification bell so you don't miss our next video. See you next time.